Two households give the same $4,000 to the same church this year. Same amount, same month, same envelope on the same Sunday. One of them pays tax on that money and the other one does not. The difference is not how much they earn, and it is not a deduction either. It is which account the money came out of, and the order it traveled in. Both households are over 73. Both have a required withdrawal from an IRA. They have to take whether they want it or not, and both are generous people. But one of them wrote a check from checking after taking that withdrawal, and the other one had the money sent straight from the IRA to the church without ever touching it. That second PAP has a name, a dollar limit that is quite large, and one procedural rule that ruins the whole thing if you get it backwards. So let us run the numbers on one household, start to finish, and then I will show you the mistake. I am Susan. This is the Retirement Lab, and everything here is general education rather than advice for your situation. The tool is called a qualified charitable distribution. People say QCD, and I will too, but hold on to the plain English version, money sent directly from your IRA to a charity which never lands in your income at all. 3 facts set the boundaries. First, you have to be at least 70 and a half, not 70. 70 and a half. And that half matters, because the rule counts from your actual birthday. And here is a piece people miss. You can do this at 70 and a half, even though required withdrawals do not start until 73. There is a 2.5-year window there where the tool works, and most people do not know it is open. Second, the annual limit this year is $111,000 per person, and it adjusts for inflation. For almost every household watching, that ceiling is not the binding constraint. Your giving is. Third, and this is the whole ballgame, the money has to go directly from the IRA custodian to the charity. Directly. If it lands in your checking account first, even for one afternoon, it is a regular withdrawal that you then gave away, and the tax treatment is completely different. Now let us do the math on one household, because a rule you cannot see in dollars is a rule you will not use. Meet a couple I will call the Hendersons. He is 74, she is 72. His IRA is the big one, and his required withdrawal this year is $9,000. They give about $400 a month to their church, and another $1,200 a year to a food bank, so call it $6,000 of giving for the year. They take the standard deduction like the large majority of retired households do. Here is version 1, which is how they have done it for 11 years. He takes the full $9,000 withdrawal. That $9,000 goes onto their tax return as ordinary income. Then they write checks totaling $6,000 to the church and the food bank across the year. Because they take the standard deduction and do not itemize, those checks change their tax bill by exactly nothing. They gave $6,000, and the tax code did not notice. Now version 2, same generosity, different plumbing. He calls the IRA custodian and asks for $6,000 to be sent directly to the two organizations as a qualified charitable distribution. Then he takes the remaining $3,000 of his required withdrawal in cash for himself. Look at what changed on the tax return. Instead of $9,000 of income, he shows $3,000. The required withdrawal is still satisfied in full, because a QCD counts toward it. The charities receive exactly the same $6,000. Nobody gave more, nobody gave less, nothing was donated to a scheme or a product. The Hendersons simply moved $6,000 off the income line. And I want to be careful here, because I am not going to tell you what that saves them, since it depends on their bracket and their state. What I can tell you is the structural fact, $6,000 that used to be taxable income no longer is. Everything downstream of that income number gets calculated on a smaller figure. That downstream part matters more than people expect, and I will keep it general because each household differs. The amount of your Social Security that gets pulled into taxable income is driven by an income calculation. The Medicare premium surcharges are driven by income thresholds 2 years back. I am not going to run those numbers tonight because we have separate episodes for both. But understand the shape. Lowering the income line is not one benefit, it is the first domino. Now here is the part that makes QCDs different from every other charitable strategy you have heard about, and it is the reason this matters for ordinary households and not just wealthy ones. A QCD is not a deduction, it is an exclusion. Deductions only help you if you itemize, and most retired households do not, because the standard deduction is large and their mortgage is gone. That is why so many generous retirees get no tax recognition at all for years of giving. A QCD does not care whether you itemize. It removes the money from your income before the deduction question is even asked. So if you are over 70 and a half, take the standard deduction and give money to charity every year. You are the exact person this was designed for, and there is a good chance nobody has ever mentioned it to you. Let me run a second household, because the first one is the easy case, and a lot of you are in the second one. Meet a woman I will call Ruth. She is 71 and a half. She has no required withdrawal yet because those start at 73. Her income this year is a Social Security check and about $18,000 she takes from her IRA to cover the gap between the check and her actual life. Ruth gives $3,000 a year, split between her church and a hospice organization that took care of her husband. Because she is past 70 and a half, she can do a QCD right now, even with no required withdrawal in play. So instead of taking $18,000 and writing $3,000 in checks, she takes $15,000 for herself and sends $3,000 directly from the IRA. Her spending does not change by $1. Her giving does not change by $1. But $3,000 of what used to be reportable income simply is not, and that is true in each of the 2 years before her required withdrawals even begin. I bring Ruth up because most articles about this tool are written as if it only exists to offset a required withdrawal. It does that, and that is the headline use. But the eligibility starts at 70 and a half, and for somebody like Ruth, those early years are quietly the most valuable ones, because her income is low enough that every dollar removed from it does real work. Now, when is this not the right move? Because I am not going to pretend a tool has no edges. If you itemize your deductions and you own appreciated stock in a regular brokerage account, donating that stock directly can be the better path, because you may avoid the built-in gain and still get a deduction. That is a different episode and a different set of rules, and if that describes you, it is worth asking about before you default to the IRA. If your charitable giving is very small, say a couple $100 a year, the paperwork friction may not be worth it. Although honestly the friction is one phone call and then a repeat instruction, so the bar is low. And if you are under 70 and a half, this door is simply not open yet. Not at 70, not at 69 and a half. Write the date on your calendar, because I have seen people do this 3 months early and end up with a taxable withdrawal and a donation instead. Now, the mistake. This is the part I would put on the refrigerator. If you take the money out first and then donate it, it is not a QCD. The withdrawal counts as your income, and your gift is just a gift. Same money, same charity, same year, entirely different result. So the instruction is specific. You call the company that holds your IRA and tell them you want to make a qualified charitable distribution. They will either send a check made out to the charity, sometimes mailed to you to forward unopened, or they will send it directly. Some custodians give you a checkbook attached to the IRA for exactly this purpose. What you must never do is transfer it to your own account as a step in the middle. A few practical notes that keep this clean. Get the acknowledgement letter from the charity, the one that says you received no goods or services in exchange. You need it for your records the same as any donation, and the charity does not automatically know your gift was a QCD. Do it before the last week of December. Custodians get slow in late December, and the transfer has to actually complete inside the calendar year to count for that year. I would aim for the first half of December at the latest, and honestly, doing it in October is better. Tell your tax preparer. This one surprises people. The tax form your custodian sends will show the full amount that came out of the IRA without separating out the part that went to charity. If nobody tells your preparer, the whole withdrawal can end up reported as taxable income and you lose the benefit you already earned. One sentence at tax time protects the entire thing. And if you are still contributing to an IRA after 70 and a half, which some people with earned income do, mention that too. There is an adjustment rule for that situation. It is technical, and it is exactly the kind of thing a preparer handles in 2 minutes and a video should not attempt. A couple of quick boundaries so nobody wires money into the wrong thing. This is for IRAs. Employer plans like a 401k do not work this way, though money moved into an IRA can then qualify. And the receiving organization has to be an eligible charity, which most public charities are, but certain kinds of funds and accounts are excluded. If you are giving to a normal church, food bank, hospital foundation, school, or relief organization, you are almost certainly fine. If you are giving to something more structured, ask first. Let me put the whole thing together. You must be 70 and a half or older. The limit this year is $111,000 per person, and it adjusts with inflation. The money must travel directly from the IRA to the charity, and if it touches your account first, it does not count. What you send counts toward your required withdrawal, so a $9,000 requirement with a $6,000 QCD leaves $3,000 for you to take. And unlike a deduction, it works whether or not you itemize, which is why it fits ordinary retired households so well. Here is what I would do this week if any of that sounds like you. Add up what you gave to charity last year. If the number is anything at all and you are over 70 and a half, call your IRA custodian, ask what their process is for a qualified charitable distribution, and write the answer down. That is the whole assignment. The giving does not change, only the pipe it travels through. And one last thought, because this is really a story about how quietly money leaks. The Hendersons were not doing anything wrong for 11 years. They were being generous with the wrong account, and nobody told them there was another way. That is most of retirement planning, honestly, not heroic decisions. Just checking whether the thing you have always done is still the best version of itself. Tell me in the comments whether you had heard of this before tonight, and if you have used it, what your custodian's process looked like, because they all handle it a little differently and somebody reading is about to make that phone call. I am Susan. Run your own numbers, write down your assumptions, and I will see you in the next one.